Well, I just went all in on high growth stocks for 2022. And I believe that you will be raking in the tendies if you have diamond hands with your high growth stocks. I know that intro was very cringy, but I couldn't pass up the opportunity. But there are several key stock market indicators right now flashing at us, telling us that January could be a monstrous month for high growth stocks. And in today's video, I'll be taking you through each individual one of those indicators and explaining my thought process on why I am going all in for the month of January on high growth stocks. But before we get into it, I have to get the not so fun stuff out of the way. If you guys are new here or returning and not yet subscribed, I'd greatly appreciate you hitting that subscribe button down below. And if you feel comfortable sharing, leave a stock or a ticker symbol down in the comment section that you believe is going to perform great in 2022. But without further ado, I don't want to waste any more of your time. Let's go ahead and get into this video. I assume we all are aware, but large cap valuations are astronomically high. Like, we haven't seen these valuations since the tech bubble, which was when I was born. But that's scary. In the small cap valuations, they remain historically low. So what exactly is going on here? People think it's just a bunch of science and it's hard to understand, but it's not hard to understand what's going on. Let me break it down for you. According to this graph by Bloomberg, the top 10 largest stocks in the United States, just like I mentioned, have valuations we haven't seen since the tech bubble. But outside of these top 10 stocks, it seems like all the other stocks in the entire stock market have been red for the past year. It just doesn't make much sense. But it does make sense. What people don't realize is that these big, large institutions, when they buy into the 10 largest stocks in the United States, that's effectively their way of going into cash. Institutions and big money are paid by their investors to stay invested in the stock market. But when they don't see great opportunities out there, they just end up buying the 10 largest stocks in the United States because then at least they can reach that benchmark that their investors require from them. Basically, at least meeting or matching the performance of the S&P 500. If you buy Google and Apple, you're going to do that on any given year because they make up so much of the S&P 500. So although this might seem crazy and complicated, it's really not. Big institutions and big money are simply selling out of all of their stocks and buying the 10 largest stocks in the United States because that is effectively cash for them. To emphasize this point even further, we can see that last week when the S&P 500 closed at a 52-week high, by the way, that's like the 70th 52-week high of the year for the S&P 500, 334 companies trading on the New York Stock Exchange hit a 52-week low, more than double the amount that marked new one-year highs. That is ridiculous, and this just emphasizes this point even further. There's only a handful of companies out there that are outperforming, but the vast majority of the market is significantly underperforming. So if your portfolio has been in the dumps this year, you're not alone by any means. Now, just to review, when I say that investors pay big money managers or institutions to keep their money invested, it basically means that those institutions and the big money managers can't go into cash because then the cash is just sitting there and they're not returning any investment to whoever supplied them with that cash or their customer. They need to stay invested, and by buying the top stocks in the United States, you at least can match the performance of the S&P 500. And this is something you see a lot more of as you near the end of the calendar year because most hedge funds, believe it or not, actually sell out completely. And when I say sell out, they sell out of all their stocks and buy these 10 largest stocks and basically go all into cash. The reason they do this is because at the turning of the year, as the ball drops on New Year's Eve or New Year's Day, technically, they can then start the new year with a clean slate and not feel any attachment based on the unrealized gains or unrealized losses of any stocks they may hold. It's a big reset for hedge funds. They then just basically analyze what stocks or types of companies they believe will outperform in the current year or 2022 in this case. Then they end up cycling that money out of the largest stocks and into those stocks that they believe are going to outperform the market indices or the benchmarks. You saw this take place more than ever before in prior years because there were a lot of tax loss harvesting opportunities out there for big money managers and institutions to take advantage of. So to wrap this all up, basically big money, institutions, and hedge funds are pushing the big reset button and taking the tax loss harvesting opportunities they have in order to not pay the taxes, because nobody wants to pay taxes unless you're crazy. Now let's dig a little bit deeper into the valuations between large caps, mid caps, and small cap companies in the S&P. On the top, as I've already covered in this video, we can see illustrated that large cap valuations are higher than they've ever been since the tech bubble, which is a scary thought. Mid caps are more in line with what we've seen historically for mid cap valuations, but then small caps seem to be historically low, and they keep going lower and lower and lower, while the large cap valuations just are consolidating and not really going anywhere. They're not going higher and they're not going lower. But as you can see, thanks to this Yardeni research report, the smaller the market cap, the more extreme this gets. And I want to even go deeper than the S&P 600 small caps. Basically, what this bottom graph is showing is basically companies valued anywhere between $700 million and $3.2 billion. And don't get me wrong, small caps are extremely cheap, but I just want to take this even further. Let's look at these smaller companies, these sub $1 billion market cap companies, and we'll see that this trend continues. Now on the screen, I have a chart depicting and comparing the performance of small caps and micro caps compared to the S&P 500. If you want particular details, the blue line is the IWC, which is an iShares microcap index. The black line, of course, is the S&P 500. And I've highlighted any time we've gotten any gap or discrepancy in the performances between the two indexes. You can see anytime there's been a gap in the performance of the two, it always resets. It's what history has told us happens anytime things get out of line. Anytime the S&P 500 has started to outperform the small caps and the micro caps, then the small caps and micro caps catch up relatively quickly, and even in some cases end up outperforming the S&P 500. Obviously, the opposite can be said. There have been times where the small caps and the micro caps have vastly outperformed the S&P 500. For example, in October, in March of 2013 and 2014, the small caps were vastly outperforming the S&P 500, but guess what happened? It corrected very, very quickly, and all of a sudden, the S&P 500 was outperforming the small caps and the micro caps. And right now, we're seeing about as big of a gap as we've ever seen, as big of a discrepancy as we have ever seen between the performance of small caps, micro caps, and the S&P 500. And guess what's going to happen? This isn't going to be any different. History has told us that this is what's going to happen. The gap is going to close, and this is going to fix itself. Things are going to reset. Now, I want to illustrate this current gap even further. So let's zoom into the 6-month chart comparing the performance of the IWC and the S&P 500. This is what the performance of the last 6 months looks like. The gap between the IWC and the S&P 500 performance is very large right now. In fact, the S&P 500 is up almost 10% over the last 6 months, while the IWC, or the small caps and micro cap companies, are down 10%, and even were down further than that not long ago. I should also probably highlight that the high growth stocks, the vast majority of them, fit into either the S&P 600 small cap index or the IWC index. You generally don't see large cap companies have high growth like the small caps and the mid caps and the micro caps do. It's just the way it is. Moving along, it is no secret out there that the small caps and mid caps and the micro caps have been underperforming significantly in December in particular. And on the screen now, I have data that dates all the way back to 1926, telling us that the stocks that performed the worst in the month of December are the stocks that perform the best in the month of January in the following year. And it's pretty evident that the high growth stocks and the stocks that have been tax loss harvested have significantly underperformed in the month of December. So what this tells us, this data dating back to 1926, is that more than likely January is going to be a big month of rebound for these high growth stocks. Now, whether or not that continues throughout the rest of the year, that remains to be seen. But this is the reason that I am all in on high growth stocks going into the new year of 2022. I've shown you multiple different metrics, multiple indicators, lots of data that dates back a long time, proving that more than likely these stocks are going to vastly outperform in the month of January and probably even throughout the rest of next year, 2022. And even if that isn't the case, I've always been a long-term minded investor. I don't invest for 1-year returns, 6-month returns, or even 2-year returns generally. I'm more looking for 3 to 5 year returns. If I think I can buy into a stock and make an investment that will return me lots of money over the next 3 to 5 years, I will make that investment. So even if this doesn't happen, even if January doesn't end up being all that spectacular and 2022 is another letdown, it really doesn't matter to me. And people on the internet forget that, these are my own investment decisions, and that doesn't mean I'm requiring anybody else to make these investments with me. I'm simply sharing my own thoughts, opinions, and ideas, and I could very well be wrong about all of this. I am not a financial advisor, so there's the quick disclaimer for this video. But now, just to close this video out, I want to discuss what I personally am looking for going into 2022. We know that right now the Fed is planning on raising interest rates 3 times next year in 2022. This is a big deal for high growth stocks because all of a sudden, as they raise the interest rates, their access to capital gets much more complicated and difficult. So what I personally am looking for in my investments are companies that have high margin, high cash flows, and very limited debt. There's always a handful of stocks that outperform in any given year. There's not many of them, but if you find them, you can take advantage of it and vastly outperform the markets. And right now, I see the opportunity in these high growth names. And in today's current market, there's a lot of stocks out there that are nearing the area of being priced for bankruptcy. And let me tell you, the vast majority of these high growth stocks are not going to go bankrupt. But what you need to look for to avoid the mistakes, to avoid the companies that will go bankrupt when interest rates are raised, you need to avoid companies with massive debt loads and low cash flows. Because if interest rates are hiked, their debt gets even more harder to pay off. And if they don't have cash flows to pay off their debt and their access to capital got all the more difficult, they have to come up with the money somewhere or they're just going to have to close the business and go bankrupt. Companies aren't going to be getting any more free money from the government and they're going to have to scrap up cash from other places in order to grow their business. 2020 and 2021 were very favorable environments for high growth stocks because the access to capital was very easy and you got basically free money to invest in your business and grow your business. However, this is going to change next year, and that's why I'm looking specifically at those items. Very limited debt, if any debt on the balance sheet, and you need lots of cash flows and a high margin business model. But anyways, I'm going to leave this video here. Don't forget to comment down below a stock or a ticker symbol that you believe is going to perform very well in 2022. I'm always curious to hear what you guys are looking at. If you guys enjoyed this video, hit the like button. Feel free to share this with anybody interested in the stock market. And with that, I hope you have a great rest of your day. I'll be back with a brand new video tomorrow for the last day of the year. Peace out.